mean, let's be honest, broadly, it has not been great for what's loosely defined as the hedge fund industry, or so-called active management, with the usual things we mentioned, potentially leverage, et cetera, that a quote-unquote hedge fund manager could do. The market environments, interest rates, too many of them, more efficient markets. We could argue that, and certainly I look forward to your feedback. But broadly speaking, right now, over the last couple of years, passive has won versus active. Why should an investor with the resources and knowledge and to some degree expertise consider that hedge funds should still be a part of a portfolio when it looks like net of fees and taxes, when you add that on, it doesn't look as good the last couple of years?
Yes, Angelo, you're absolutely correct. A passive investment in the S&P 500 over the past couple of years would have, in a relative comparison, outperformed most hedge fund indices. And I think that we need to kind of put it into perspective in terms of, hedge funds are not meant to take on tremendous amount of equity or beta risk and aren't positioned to try to beat the S&P on a purely performance basis, but on a risk-adjusted basis. And I think that's a very important aspect of thinking about hedge funds in a portfolio. When we look back into time periods like 2008, they had, hedge funds did outperform the S&P. We're not down as much, and more importantly, I think that it's important for all of the listeners to start considering risk in the terms of a drawdown perspective and not volatility. The amount of drawdowns that your hedge funds have experienced during very difficult times for equity indices or credit and liquidity events are substantially less than the type of drawdowns that a passive index would. Let me just give you a very simple example. When we had that downturn in crude a couple of years ago from 100 to 50, and then conversely further down to 20, we had investors that were in long-only MLP indices suffered close to 55% drawdowns. Had you been in an active manager in the hedge fund space that are dedicated to MLPs, long biased nonetheless, given the underlying strategy, they suffered less than half of that drawdown and recovered much quicker than that MLP index. And so many of our family office clients, which had a dual investment in both the passive and the active, immediately decided to shift all of that to the active manager, recognizing that information and the ability to act and reduce risk was a very important aspect of preserving capital.